talk about a confusing subject. This is like my third take on this video. I'm trying to figure out how to explain something simply. So what I'm going to do is not explain this topic fully because it's too confusing. So let's get started and you see what the heck I'm talking about. Let me minimize myself. What I'm talking about is how to read the COT, CFTC. I know that's a lot of acronyms. That's the Commitment of Traders from the CFTC, Commodities Futures Trading Commission, basically, their report. I'm showing you how to read basically positioning, essentially from speculative traders and commercial dealers. I'm going to show you how to read that. Why? Because what's all over the news lately is these charts here, all these charts. And let me minimize myself again. So this chart here is from Raoul Pal, who runs Real Vision and GMI. And what he's talking about, you can see on top, extremely short, he's saying. Everyone's very, very short. And he's saying that's providing fuel for the fire. So what he's talking about is that if you look at the CFTC aggregate net speculative position on U.S. Treasuries, he's saying here, he's keeping it simple too, because this is not how it's presented from the CFTC. What he's showing is that speculators like hedge funds, let's just keep it at that, they're all shorting treasuries. So they're betting that rates are going to go up. So what he's saying, and I agree, is that there's fuel for the fire, meaning if everyone's leaning on one side of the seesaw, there's nowhere for it to go but the other way. So in other words, if everyone is shorting treasuries, the odds are that treasuries are going to jump and go much higher, meaning that rates are going to go much lower. Now, a better way of presenting this, and you have to pay for this, it's very difficult to get what I'm about to show you. Because the problem is when this is net speculative positioning, we don't know how much open interest there is. So here, if you look at this carefully, this title, he's looking at the S&P, and again, they're shorting, but this time they're shorting by speculators of the S&P 500. And if you look here, it says as a percent of open interest. And this is the highest quality way of examining the shorting by speculators in the CFTC, on the CFTC, I should say, because it's adjusted for open interest. So that means you can go get an evolution. You can go back in history. Unfortunately, it's hard to find this data unless you pay someone like Raoul Pal for this data. So you can see here, everyone's bearish on the S&P 500. So again, he's saying he's bullish. So remember, this data has to always be read as a contrarian indicator. So here's something I want to add. I mentioned already one, that you got to it's better to look at it from a percent of open interest. The second thing I want to talk to you about is you should be looking at all the products within a category. So if you're looking at the equity market, don't just look at the S&P 500. Look at the mid-cap, look at the Dow Jones, because they have futures on the mid-cap index. They have futures on the Dow. The third thing I want to talk to you about is here's a Dow mini futures, by the way. But what I want to talk to you about is this. This is more raw data. This is from Barchart.com. They take the raw data from the CFTC, they take the Commitment of Traders data, all kinds of traders and commercial players. What they do is they present it in this nice launch pad. And what I want to talk to you about for my third point is that and I mentioned this before, if you're looking at treasuries, don't just look at one treasury type. See, it's on the financials here. Let me blow that up. You got to look at all of these, especially the 30-year bond, the Ultra T bond, the 10-year T note, the Ultra 10-year note, the 5-year note, and 2-year note. Now, the shorter-term notes I would look at for a few reasons. Number one, we got the debt ceiling, so it's all screwed up. Number two, the Fed has said they're going to raise short-term rates, so that's going to affect the short-term rates. The odds are very high that the traders are going to be correct about shorting the shorter-term treasuries here, up to 2 years, especially the 30 days, because the Fed did say they're tightening. But here it's very important on the longer term rates. This is where you want to see if there's some real shorting going on. Now, you have to be careful. There isn't too much liquidity in some of these. So you want to look at 2 or 3 of them. Like I would look at the Ultra T note, T bond, and the 10-year note. So if you click on it, you could see, like Raoul Pal said, there is a lot of shorting. It's not turning up. For some reason, it's not being downloaded. Here we go. Now it's downloaded. So here's a 30-year bond. You can see the green means when it's below when it's below this middle line here, it's negative. You can actually see on the right side here, it's saying minus 61,000 contracts. And if you go, I mentioned earlier, if you go to the Ultra T bond, you could see the shorting because the green line, which means speculators, is below the red line, and the red line are commercial dealers. And again, if you go to the 10-year note, you can see speculators, the green line again, are really low, and they're much lower than the red line, which are the commercial dealers. And you could go back to like 20 years, or it's not showing up now for some reason. It's not downloading. But basically, if you went back, you would see that we've got the most shorting in history. And I'm still clicking on them. I'm very stubborn. And so basically, you would see that if you go back 10, 20 years, that we've got the most shorting, meaning the green line, just imagine a green line, is lower than a red line. Let's see if I got it here. No, I didn't click on it. So that's annoying me. Let me click on it one more time. Let me hit refresh and see if that comes up. No, it's not coming up. But you would see that there's a lot of shorting. Oh, here we go. Over 6 months, we're getting the shorting. You can see green is much low. Let's go back. Let's hit max and see what happens. Okay, it's not working, but you get the point. So that was the 3 main points I want to tell you quickly in under 10 minutes. Number 1, let's review them. You should not just look at one product, look at all the financial products. 2, try to get, if you can get your hands on this data, try to get the positioning of the COT data as a percent of open interest, because it makes it apples to apples going way back in history. So here you could see at the market bottom, there was a lot of shorting. So this is bullish for the market, right? Because this is a contrarian indicator. And number 3, you want to, I didn't mention this too much. I should have said this earlier. You want to see confluence where the financial data, the shorting on the financials, which we talked later, is jiving with the shorting on the S&P 500 and all the other indices. And that's also jiving with metals, especially gold. And that's also correlated and jiving and making sense with the dollar. For example, if they're shorting Treasuries, you want to make sure that the speculators are long the US dollar. And again, unfortunately, for some reason, it's not downloading. Let me try to get something short term. Like, let me get 3 months. I think that'll turn up. 3 months on the dollar. This is probably the Dixie index. Yeah, okay, this is a 1 year. This is not as good as I wanted to show you, but you get the point. So I said shorting, I meant long. You want to make sure that they're long, that speculators are long the US dollar. Now, you're probably wondering why. And this is what I said earlier. Remember, let's forget about all these charts and the commitment of traders and futures. Let's just think about correlations. When the stock market goes up, the US dollar index tends to go down. And interest rates tend to go down, especially in this regime. You have to remember, you have to think about what regime we're in. We're in a regime where when rates go up, when treasury rates go up, stocks go down. So let's put that all together again. When the stocks are going up, the US dollar index goes down, and rates are also going down. So you want to make sure that the speculative positioning by hedge funds are representing that you want to make sure from a contrarian point of view that all the speculators are heavily long the US dollar, that they're heavily short treasuries, and that they're heavily short the S&P 500 and other indices. And that, my friends, is called confluence within the futures positioning. Now, not to confuse you anymore, there's also confluence using other data indicators, trend lines, Bollinger Bands, Fear greed. I like to use the CNN fear greed index. I have my own set of sentiment indicators. You can look at momentum indicators. You could compare the credit spreads of, for example, the high yield credit spread with investment grade spreads or what's going up the Nasdaq. All these theoretically should be correlated. If not correlated, then your prediction ability will decline. So I hope on this third take of this video that it was easier for you to understand, and I hope I did a better job at explaining this. Thank you and adios.